You think banks lend out money that someone else saved. They don't. When you walk into a bank and get approved for a $10,000 loan, the bank does not open a vault. It does not transfer someone else's deposit. It doesn't move stacks of cash around in the background. It types numbers into your account. Your balance goes up by $10,000. At the same time, the bank records that you owe $10,000 back. That's it. New money just appeared. And no, this isn't a loophole. It's how the modern financial system is designed to work. Right now, the majority of money in the US isn't physical cash. It's digital entries inside bank databases. And most of that money was created the exact same way, through loans. Here's the simple version. Imagine the economy has $1 million in total money. If banks only lent out existing deposits, that number would stay the same. Money would just move around. But that's not what happens. When a bank approves a mortgage, a car loan, or even your credit card limit, it creates a deposit out of thin air. That deposit becomes spendable money. Sellers receive it. Employees get paid with it. It circulates. Money supply expands. Now here's the part most people never hear. When you repay the loan, that money disappears. The bank deletes the deposit as your balance goes down. The only thing it keeps is the interest. So, money is born when loans are issued, and money dies when loans are repaid. Which means something uncomfortable. Our money system runs on debt. No new borrowing, no new money. If borrowing slows down, money creation slows down. If borrowing collapses, money supply can actually shrink. That's not theory. It has happened before. During financial crises, banks tighten lending. Businesses can't borrow. Consumers pull back. Loan growth falls. And suddenly, the money engine slows. The system isn't powered by printing presses. It's powered by confidence. Now you might be wondering how this is legal. Because banks aren't creating money randomly. They're creating it against a promise, your promise to repay. That loan becomes an asset on the bank's balance sheet. Regulations require capital buffers. Central banks oversee liquidity. There are guardrails. But within those guardrails, banks are allowed to expand the money supply through lending. It sounds extreme, but think about the alternative. If banks could only lend out existing deposits, credit would be limited. Economic growth would slow dramatically. Home ownership would shrink. Business expansion would stall. So the system chose elasticity instead. Flexible money, expandable money, debt-backed money. And here's the irony. We're taught that debt is dangerous, and it is if it grows too fast. But without debt, the modern economy doesn't function. Too much borrowing creates bubbles. Too little borrowing creates recessions. So banks sit in the middle, quietly typing money into existence, as long as someone is willing to sign the paperwork. Now zoom out. If most money is created through loans, then whoever controls lending conditions controls money creation. Interest rates, credit standards, risk appetite. Change those, and you change how much money exists. Which means the real power isn't just in government spending or tax policy. It's in the cost of borrowing. And that raises a bigger question. If money is created as debt, and debt must keep expanding to maintain stability, what happens in a world where people can't afford to borrow anymore? That's not a conspiracy. That's math. This is Capital Thesis. If this made the system clearer, subscribe and comment what topic we should break down next.